Hi, my name's David Bell, and I'm the author of the Macrodesiac newsletter. And today I just want to chat a bit about my thoughts on Fed activity going forward and what my thinking is towards how this will affect equity markets. So let's check out this first chart where I've overlaid the Russell 2000 with the Fed funds, which is in yellow, and unemployment in orange. And I've picked the Russell since it has a more sensitive correlation to the wider economy. Now, what do we notice first? Well, unemployment is at a record low pretty much. And lows in unemployment are generally correlated with the top of the business cycle or market cycle. And whenever the Fed starts to turn dovish again, we actually see that figure start to increase. And in Q1 2019, it was the worst quarter for layoffs in a decade. And obviously, we've heard coming out of the Fed from Jerome Powell, we've heard him, kind of come to a pause now with rate hikes. And accompanying this this increase in unemployment has been a drop in the Russell every single time. So currently, a rate cut of 25 basis points, if you can see in the next table chart, is priced in at 31.9% for the December 2019 Fed meeting. I personally think this will come sooner, because if we take a look at the third chart of US industrial production, it's really not been that great over the past year or so, and data released yesterday showed a contraction of 0.1% month on month. So that was for the March number. So this can mainly be attributed to the lack of demand for cars currently. The Q1 layoffs were predominantly in the car industry. And we've also seen earnings per share be revised down globally as well. And actually back in August, I mentioned on LinkedIn or one of my social media profiles, that South Korean exports were a leading indicator for global earnings per share growth, but they totally collapsed. And then what we saw through the autumn, what happened after that, the equity markets fell off. And it wasn't a very great time, was it? But South Korean exports are actually still contracting. There's been a slight rebound, but, still negative on the year. And this provides me with a kind of a signal that global aggregate demand is still muted, and also that inflation expectations will also be muted, which actually brings me on to this next chart. And this is of the Taylor rule plotted against the Fed funds rate. We've had the sharpest contraction of this Taylor rule prescription of negative 0.75% since 2015. And I think it's a totally ridiculous measure to use, but the Fed does use it. So, it's kind of something we have to pay attention to. It's quite a backward thinking measure, for me, it's useless. But I think that interest rates should be based on the market anyway, and not by a group of people deciding what it should be. But anyway, I digress. It essentially identifies where they should be keeping the rates. And such contraction shows that a cut could be becoming more and more likely. I'd say over the next few months, before I action anything, I'd really want to be looking at what unemployment does. But I really can't see too much upside in the Russell or equity markets in general. 40% of the Russell makes no money anyway. So, if the data really does become worse and worse, you could really see that index start to tank. But thanks for listening, and I'll speak to you soon.